Welcome to the deep dive. Our job, well, it's pretty simple, really. We take these dense financial reports, these strategic blueprints today. It's the third quarter 2025 results for the super app giant, Kaspi.kz, and we pull out the critical knowledge you need.
Exactly. We're looking at Caspie today, mainly operating in Kazakhstan, but also pushing hard into Turkey.
It's a really fascinating story, isn't it? You've got this platform dominating its home market, Kazakhstan, while strategically pouring capital into a huge new market, Turkey.
It really is. And for you listening, this is it's more than just an earnings call summary. Kaspi.kz is a prime example of this modern phenomenon, a full-stack digital ecosystem.
Right. Payments, commerce, financing, all integrated into one app.
Precisely. And the core narrative we're digging into today is their ability to keep up that rapid, high-margin domestic innovation while, at the same time, navigating some pretty significant temporary external turbulence.
Yeah, those financial and supply chain headwinds they mentioned.
Exactly. Major headwinds.
So our mission today, let's dissect the performance of those three core pillars: payments, marketplace, and fintech. And then we need to pivot to the future.
Right. Understand the impact of the new tech they're rolling out.
Especially that pay-by-palm system, Caspie Alcoin, and their AI tools, CASBI. Sounds almost sci-fi.
It's pretty cutting-edge stuff. So, okay, let's start with a high-level snapshot. 3Q 2025. At first glance, the consolidated results, they might look a bit restrained.
Yeah, reported consolidated revenue growth was 20% year over year.
And consolidated net income up 12% year over year. Solid numbers, sure, but like I said, they don't quite tell the full story.
Okay, so this is the critical insight you need to keep in mind as we go through this. The headline figures, they're kind of misleadingly suppressed.
That's the key. If you systematically exclude the unique temporary external factors they were dealing with this quarter.
Things like the supply chain disruption, that aggressive national base rate hike, new tax burdens.
Yeah, you strip all that away and the picture changes completely.
Okay, so what does that adjusted picture look like?
Well, when you adjust for those headwinds, the underlying, the core business performance, it accelerates significantly. Underlying revenue growth actually hits 23% year over year.
Right, up from the reported 20%.
And crucially, underlying net income growth accelerates to 21% year over year.
Wow, okay. From 12% reported to 21% underlying, that's a big jump.
It's a huge difference. And it's proof, really, that the core engine room of the business is still incredibly powerful. It's just that this temporary noise is masking the true growth path.
Okay, let's unpack that noise then. It's actually a great example of how these big macroeconomic factors can distort what looks like otherwise pretty stellar performance. So, Section 1, navigating external headwinds and capital strategy. Why were those reported numbers softer? What exactly were these dampeners cutting into net income?
Right. We can trace this deceleration back to 4 specific countrywide factors in Kazakhstan. And the key here is they're expected to be short-lived, mostly easing off by 2026.
Okay, what's the first one?
The most tangible one, the one that really hit the marketplace platform hard, was the smartphone disruption.
Ah, yeah, I remember hearing about that. It wasn't just a general economic slowdown, was it? It was more of a technical bottleneck in the supply chain.
Exactly right. Kazakhstan brought in these complex new registration requirements for imported smartphones this quarter.
Okay.
And that immediately created a countrywide supply disruption. It just made it harder and slower for vendors to bring in inventory.
And wasn't there an issue with new models, too?
Yes, compounding that. New, highly anticipated global models they specifically mentioned, a shortage of the iPhone 17, were just scarce.
So consumers held back.
Exactly. People ready for an upgrade just delayed their purchases, waiting for supply to get back to normal or for those new models to finally arrive. This single factor, just the smartphone issue, shaved a notable 8% off the marketplace's gross merchandise value, the GMV growth.
8%? That's a massive headwind for any e-commerce platform.
Huge. And a supply disruption like that, it has knock-on effects. Beyond the marketplace, their fintech and payment segments also had regulatory hurdles on the financial side.
Right. The regulatory and tax changes, what were those specifically?
Yeah, 2 changes hit their margins directly. First, they introduced a new 10% tax on revenue they get from government securities they hold.
Okay, so that's just a straight tax leakage.
Pretty much. Yeah. Second, and maybe more insidious, was the increase in minimum reserve requirements, or MRR.
Right. Let's clarify MRR for everyone listening. This isn't a tax on profits. It's more fundamental. It reduces their ability to earn interest. Is that right?
That's exactly it. The central bank tells financial institutions they have to hold a certain percentage of their customer deposits as reserves. Simple enough. But when the MRR goes up, Caspie has to lock away more of its balance sheet capital with the central bank.
And they earn nothing on that locked-up capital.
Zero interest. It's just non-interest earning capital stuck on the central bank's balance sheet. So it adds like a direct, non-negotiable tax on their operational efficiency, on how they deploy their assets. It forces a hit to profitability, even though their core loan and deposit businesses are actually doing well.
So those two regulatory items, the tax and the MRR, increase what was a combined impact?
Roughly a 4% hit to consolidated net income growth year over year in Q3.
Okay. And then the final factor, the one that, well, pretty much all financial institutions everywhere are dealing with right now, the base rate increase.
Yeah, the National Bank of Kazakhstan, the NBRK, hiked its base rate pretty significantly, moved it from 15.25% up to 16.5%.
And this is where the margin squeeze gets really painful because of the timing lag, right?
Exactly. When the base rate goes up, the cost of their funding, what they have to pay to hold customer deposits, that goes up almost overnight.
Right.
But the yields on their existing loan portfolio, they adjust much more slowly, often lagging by several months, maybe even a full quarter, because a lot of loans are fixed rate, or they just take time to reprice.
So they're paying more for deposits immediately, but their lending revenues haven't caught up yet. Creates that immediate painful margin compression.
That's precisely the mechanism. This higher base rate created a really significant expense headwind. Cost them about 3% of consolidated net income growth year over year in Q3. It's a temporary financial drag, sure, but it masks the true acceleration in their underlying lending volume and quality.
Okay. So putting it all together, smartphones, the new tax, the MRR change, and the base rate hike, it makes sense that they had to revise their full-year guidance for 2025 in Kazakhstan.
That's excluding Turkey, right?
Correct, excluding Turkey.
Yeah.
They moved from their prior guidance back in March 2025, which targeted around 15% year-over-year net income growth, down to an updated guidance of 10% to 12% UOI growth. They announced that in November 2025. But the key distinction, and this is the one investors really need to focus on, is that if you mentally back out the estimated full effect of all those external dampeners,
Right.
the underlying net income growth is still projected to be 18% to 20% year over year.
Exactly. Which puts them squarely within their long-term growth expectations. It really demonstrates a business that is structurally sound.
And they signaled that confidence pretty clearly with their capital strategy, didn't they? Even with the massive investment needed for Turkey.
Right. Even with that, they announced a $100 million ADS buyback program, kicking off in November.
Why do that? Why execute a large buyback when you arguably need cash for that big expansion?
Well, it's a powerful signal. It signals confidence in the core business's exceptional cash generation. It tells shareholders, look, we're committed to shareholder returns even while we're pursuing this long-term growth in Turkey.
So it's a balancing act.
Yeah, their future plan for 2026 clearly talks about balancing buybacks and dividends with continued investment into those high-potential growth opportunities, like building out the super app model in Turkey.
Okay, let's shift gears then. Section 2. The payments platform. This is the engine room, right? The foundation of the whole super app ecosystem. How did this core metric hold up amidst all that noise we just talked about?
The payment platform, well, it continues to scale really impressively. Total payment value, TPV. That increased 18% year over year in Q3, reached KZT 11.6 trillion.
Wow.
And if you look at the 9-month period, TPV is at KZT 32 trillion. That's 21% year over year growth.
What's strategically interesting there, I think, is that the total payment value, the TPV, is growing faster than the number of transactions. Transactions grew 14% year over year.
Correct. And that difference, that disparity, is actually a really healthy sign.
Why?
It means that while frequency is increasing, people are using it more often, the average ticket size is also increasing. Consumers are getting more deeply embedded, moving beyond just microtransactions to using the platform for larger value purchases.
Makes sense. What about the mix within TPV?
In terms of composition, the majority, about 69% of TPV, comes from their standard Caspie QR and card transactions, but the fastest accelerating segment is actually B2B payments.
Okay.
It's only 6% of TPV now, but it's projected to grow faster than the overall TPV going forward.
Yeah.
That really points to deep merchant adoption. They're getting businesses hooked in.
Now let's address the elephant in the room for payments. That's slight decline in the payments take rate. It moved from 1.18% a year ago down to 1.09% in Q3 2025. A decline in margin, that always makes investors a bit nervous.
It does.
How do they convince us that this margin compression is actually a calculated strategic sacrifice and not just, a sign of intense competition eroding their pricing power?
That's a really vital question. And the answer is the decline is actually a direct strategic consequence of their success in penetrating the merchant market. It's consistent with previous periods, too.
How so?
They are deliberately accelerating the growth of lower take-rate products, specifically their merchant-focused Caspie Pay and those B2B payments we just mentioned.
Ah, okay. So those products have lower margins.
Yes, they're offered at a lower margin than consumer transactions. And the reason is to rapidly onboard businesses, build that ecosystem flywheel effect. You trade a slight decline in the blended margin for massive increases in volume, massive increases in ecosystem penetration, and crucially, data acquisition.
And that data feeds the higher margin parts of the business.
Exactly. It ultimately fuels their higher margin fintech business. It's a classic land and expand strategy built on the back of dominating payments.
That makes sense. The cost of acquiring a merchant is repaid when they start using the other super app services. And we see the benefit of this scale in their operational gearing. They reported net income growth of 12% against revenue growth of 10% in the payments segment. Can you explain operational gearing quickly and why that 2% gap is so significant?
Sure. Operational gearing fundamentally relates to the efficiency you get from a scalable digital platform. Like you said, payments revenue grew 10% year over year in Q3, but payments net income grew 12% year over year, reaching KZT 115 billion.
Okay.
The significance is that they're achieving faster bottom-line growth than top-line growth. In a software-defined business like Caspie's, once you've built the core technology, the network of terminals, those are your fixed costs. Then servicing the next million users or handling, say, KZT 1 trillion in additional TTV incurs almost zero incremental cost.
Right. It scales incredibly well.
Exactly. They're managing their variable costs exceptionally well, allowing those revenue increases to drop disproportionately straight to the bottom line. This compounding effect, that's the true long-term value driver.
Okay, let's pivot to innovation now. The announcement of Kaspi Alcoin, their pay-by-palm technology. I mean, that sounds genuinely revolutionary for a super app. What's the strategic benefit here, especially when mobile payments are already so common?
Kaspi Alcoin, which means palm in Kazakh, by the way, this is an immense strategic move. It's designed to create the ultimate competitive mode.
How?
The concept is simple but powerful. A consumer can pay for purchases without a card, without their phone, and critically, without needing a mobile internet connection at the point of sale.
Okay, that's interesting. What are the advantages?
Two huge advantages. First, it eliminates transaction friction down to the absolute minimum. Just wave your hand. That drives usage frequency. Second, and this is strategically paramount, it reduces or even eliminates the reliance on third-party mobile wallets like Apple Pay or Google Pay.
Ah, so they control the whole stack.
Completely. They own the entire payment infrastructure, from the terminal scanning your palm to the authentication on the back end. Complete vendor lock-in.
And that offline capability, that must be massive, especially in regions where mobile internet might be patchy or expensive sometimes.
Absolutely huge.
Yeah.
So what's the deployment strategy?
Yeah, how are they rolling this out?
They're starting to roll out in Almaty in December 2025, so very soon, with a national expansion plan throughout Kazakhstan during 2026.
And how are they getting merchants on board? Terminals must be expensive.
The merchant incentive is highly aggressive. Designed for rapid adoption, Caspie provides the necessary terminals completely free of charge.
Free? Wow.
Free. And they offer a 0% commission for the first 3 months. After that initial period, they just revert to the standard, already quite competitive, 95 basis points Caspie Pay take rate.
So they're really pushing this hard, building the moat internally, but they're also expanding their external reach through partnerships, right?
Exactly. Growing the addressable market both domestically and internationally. Domestically, they're integrating their QR system with 6 other local banks in Kazakhstan. Internationally, they've integrated with Obank in Kyrgyzstan and, significantly, with the Alipay Plus global partner network.
What does that Alipay Plus integration enable?
It means their millions of users can transact internationally much more easily. And conversely, it allows international tourists who use Alipay to seamlessly pay Caspie merchants when they visit Kazakhstan. It opens up both inbound and outbound flows.
Okay, so if the payments platform held up structurally despite the headwinds, let's look at the marketplace platform in Section 3. This segment, well, it faced the direct blast from those smartphone supply chain issues we talked about.
It really did.
But simultaneously, it showed phenomenal growth in value-added services, or VAS.
Yeah, this section absolutely requires that context filter again. Reported marketplace GMV growth, only 12% year over year in Q3. Looks weak on the surface.
But if you factor out the smartphone disruption,
underlying GMV growth was actually 20% year over year. Much healthier.
And the margin expansion strategy, that's clearly working here too, because revenue growth significantly outpaced even that underlying GMV growth.
It certainly did. Revenue grew 24% year over year in Q3 and a whopping 32% if you exclude the smartphone issue.
Wow.
This massive outperformance meant the marketplace take rate soared, hit an all-time high of 10.3%. That's up from 9.5% the previous year.
And that's driven by those high-margin VAS.
Exactly. Driven by the acceleration of Caspie delivery, their advertising services, and classifieds, those are pulling the overall margin up.
That shows pretty robust consumer demand outside of electronics then. Which categories are seeing the strongest underlying growth?
Well, e-commerce GMV, excluding those depressed smartphone sales, increased 25% year over year in Q3. And the demand isn't just in one niche, it's broad-based.
Like what?
Top growth categories, beauty and personal care, soaring 69% year over year.
69%.
Yeah. Clothing and accessories grew 51%. And the home, garden, and furniture categories grew 35%. It really confirms the platform is now deeply integrated into just routine consumer purchasing habits. It's not just for occasional big buys anymore.
Okay, let's talk about e-grocery for a minute. That's always a tough, low-margin vertical. Needs heavy operational investment and logistics. How is Caspie managing to scale this effectively?
E-grocery is scaling rapidly, but it works because of the ecosystem play. GMV was up 53% year over year in Q3, showing really strong consumer adoption.
And the user base.
Their active consumer base reached 1.3 million. That's up sharply from 725,000 just the year before. They are investing heavily in infrastructure, too.
How so?
They now cover Kazakhstan's 5 largest cities and operate 9 dedicated dark stores, with plans for more. That dark store model is critical for getting the speed and quality control you need for fresh and perishable goods, ensures efficiency in that crucial last-mile delivery.
And they integrated Glovo, too, didn't they?
Yes, they integrated Delivery Hero's Glovo restaurant delivery service. That creates a more streamlined, multi-vertical food delivery ecosystem, all within the single super app.
Okay. Now, let's get to the really cutting-edge tools they're developing for merchants. Specifically, advertising. Advertising revenue growing 76% year over year. 76%. That is significantly faster than pretty much any other metric in the marketplace.
Yeah, that growth reflects a massive strategic shift.
Yeah.
Caspie advertising services now let merchants manage campaigns not just on the Kaspi.kz platform itself, which is powerful enough,
Right.
but also across major third-party platforms,
Mm-hmm.
including Instagram, Facebook, TikTok, and Google.
Okay, wait. That moves them from just being a marketplace where you can buy ads to being a full-service digital advertising partner managing external campaigns. Why would a merchant choose Caspie to manage their ads on Google or Facebook instead of using a traditional ad agency or doing it themselves?
This is their competitive moat in advertising. Caspie possesses unique proprietary first-party payment and purchase data about its customers. Data that external agencies or even the ad platforms like Google and Facebook themselves often lack.
What kind of data?
They know the user's exact financial profile, their purchasing power, their loan history with Caspie, their exact transaction behavior across both physical and digital payments, what they browse on the marketplace.
Okay, incredibly granular.
Incredibly, this data allows them to run performance marketing campaigns on those external platforms with unbelievably high targeting accuracy, and therefore superior return on investment for the merchant. They are leveraging their dominance in payments and commerce data to win in the advertising space, even off their own platform.
That's powerful. And if advertising is about targeting the right people, the new Caspie assistant is about converting them once they land on the product page. This is their proprietary AI tool for automating content creation.
This, I think, is the real game changer for conversion rates. Caspie automates what's traditionally a very manual, time-consuming process, listing creation.
What does it do exactly?
It creates AI-powered product photos, enhancing existing ones, or even generating new lifestyle shots. It generates detailed product descriptions, fills in all the characteristics and specifications, and crucially, it does this in Kazakh, Turkish, and Russian.
That multi-language capability is vital for their expansion plans, especially Turkey.
Absolutely. Essential for local relevancy and multinational market expansion.
So, what's the status of the rollout? This isn't just theoretical, right? They're actually using it.
Oh yeah, it's live and already impacting conversions. It has already enriched about 500,000 of the most popular products in the marketplace.
500,000 screws.
Yeah, and they project a full rollout to all merchants by January 2026, so just a couple of months away. And they provided hard data on the uplift, which is where the implications really hit home.
Okay, let's look at those case studies. The sales uplifts were Well, they were massive.
They really were. Consider two examples they gave. For products where visual attractiveness is key, they used a kettle as an example, using the AI to enhance the imagery, and descriptions resulted in up to a 35% increase in clicks.
Okay, decent click uplift.
And an astonishing 83% increase in sales conversion.
83% increase in sales from better pictures and text.
Wow. Just from optimizing the product page content using AI. Then, for more informational products like winter tires, where quality data and specs are crucial, improving the product description via AI led to up to 40% more clicks and a 53% sales uplift.
That 83% uplift on the kettle example is staggering. This isn't just a nice-to-have feature. This is really showing the potential of AI embedding itself deep into the transaction funnel. It turns the mundane product page into a proprietary conversion engine.
That's exactly it. They're using AI to automate optimization at the single most critical point, the product page itself, which is something even massive rivals like Amazon or Alibaba struggle to do efficiently and consistently across millions of third-party SKUs. Caspie is building a conversion moat, leveraging its proprietary AI.
Okay, that leads us nicely into Section 4. The Fintech platform. This segment is financing the consumers and increasingly the merchants that drive that marketplace, all while somehow maintaining exceptional credit quality.
Right. Total finance value, TFV, that's the total value of loans originated, was up 16% year over year in Q3, reaching KZT 3.0 trillion. For the full 9 months, TFV hit KVT 8.6 trillion.
And the product mix here, it really highlights how integrated this segment is with the rest of the ecosystem, doesn't it?
It absolutely does. Buy now, pay later, BNPL, remains the dominant product, stabilizes the consumer side.
What percentage is BNPL?
It accounts for 39% of TFE for the 9 months. However, the strategically most important and fastest growing segment is merchant and micro-business finance.
Financing the sellers on the platform.
Exactly. That now accounts for 19% of TFE. And this is critical for cementing merchant loyalty, providing them with working capital they need, and ensuring that merchant-related TFE continues to grow faster than traditional consumer lending. The platform is focusing its financing where it best reinforces the marketplace ecosystem.
Smart. Looking at the balance sheet then, both the loan portfolio and the deposits are showing pretty robust growth. Seems like strong funding efficiency.
Yeah, the average net loan portfolio increased 30% year over year in Q3, reaching KZT 6.6 trillion.
And that's funded by?
Funded by equally strong growth in their average savings or deposits. Those increased 18% year over year, hitting KZT 6.9 trillion, largely driven by new competitive saving products they launched.
So loans and deposits are growing, but loans are growing faster.
Yes, and that efficient deployment of customer funding pushed the loan-to-deposit ratio up to 97%. That's up from 88% a year earlier. They are fully deploying their available capital, not letting it sit idle.
Okay, let's revisit that profitability challenge we mentioned earlier, but specifically for Fintech. Reported net income grew 15% in Q3. Solid, yes, but we know that was achieved despite that punishing external environment.
It was a very hard-fought 15% growth, yeah. Resulted in KZT 101 billion in net income for the quarter. But you have to remember their deposit interest expenses surged 30% year over year in Q3.
30% increase in funding costs.
Yes. Their overall cost of funding was up 110 basis points in that single quarter, mostly due to that NBRK base rate increase that hit them back in March 2025. They were just absorbing these higher costs while waiting for their loan yields to catch up.
So again, if we strip away that massive temporary drag from the higher cost of funding, what does the true underlying fintech growth look like?
Okay, this is striking. When you exclude the full effect of that base rate increase, the fintech net income growth accelerated dramatically to a remarkable 28% year over year in Q3 2025.
28%. So that's a 13-point difference between the reported 15% and the underlying 28%.
Exactly. That 13-point gap underscores just how much those external monetary policy factors are currently suppressing the performance power of this platform. It really speaks to extreme operational discipline on their part.
And what's really impressive is achieving that kind of underlying acceleration while keeping risk management so tight. How does their credit quality actually compare?
Their credit quality remains a key differentiator. The cost of risk, that's the expense they set aside for expected loan losses, it remained low and healthy at just 0.6% in Q3, only slightly up from 0.5% year prior.
Okay.
For the full fiscal year 2025, they expect it to be contained around 2.2%. Now, compared to many emerging market financial institutions where high growth often comes with really high risk, these are exceptionally disciplined figures. It reflects their reliance on that proprietary integrated data for underwriting decisions.
And the non-performing loan ratio, the NPLs.
The NPL ratio remains stable and very manageable. It was 5.8% for the first 9 months of 2025, only a slight uptick from 5.4% at the end of 2024. So these metrics really confirm that the high growth in lending is not being bought through reckless risk-taking.
Okay, really strong core performance in Kazakhstan across all three platforms once you adjust for those headwinds. Let's turn now to Section 5, international expansion. Turkey and the performance of Hepsibada, which they've stated is their primary long-term growth engine.
That's right. Turkey represents a massive expansion of their total addressable market. They're focused on fully integrating the super app model there. And they're currently working towards securing regulatory approval for the acquisition of Rabobank A.
Which gives them the banking license they need.
Exactly. That will give them a strong banking license to properly embed the Fintech platform within the Turkish operation.
Looking at the quarterly results for Hepsibada, there seems to be a definite improvement. Suggests they're gaining traction after that initial integration phase post-acquisition.
The momentum is definitely accelerating. They're aggressively focusing on increasing frequency through everyday orders. You can see this clearly in the marketplace. Purchases acceleration.
How so?
Well, back in the first quarter of 2025, purchases actually declined 11% year over year. That swung to positive 7% growth in Q2. And now, in Q3 2025, they've hit strong 16% year-over-year growth in purchases.
Okay, that's a significant turnaround in acceleration.
It really indicates that their efforts to drive frequency and make the platform stickier for everyday needs are working.
And despite the, let's say, challenging inflationary environment in Turkey, the top-line figures look pretty solid, too.
They do. GMV growth accelerated to 15% year-over-year in Q3, reaching TRY 51.2 billion. Revenue growth was even stronger, up 22% year-over-year to TRY 20 billion in the quarter.
Okay, strong top-line acceleration. But to really understand their strategy there, we have to focus on the profitability side, or maybe the lack thereof currently.
Exactly, the deliberate profitability sacrifice.
Right. The EBITDA decreased significantly, down 74% year-over-year in Q3. That's a massive drop in profitability, even for a company in a high-growth phase.
It is, but it's entirely by design. This is Caspie deploying its established super app playbook. Scale first, profitability later. The EBITDA decline directly reflects highly targeted investment spending.
How much are they spending?
Total TRY 4 billion just in Q3 2025. That's up significantly from TRY 2.7 billion in the same quarter the previous year.
So they are intentionally burning cash to capture market share and build the ecosystem. What are the core areas they're investing in? They mentioned 4 specific things.
Yeah, they're focused on building that ecosystem foundation rapidly. First, improving the delivery proposition. That includes launching essential services like weekend delivery and, crucially, reducing shipping costs for low-ticket items to encourage those daily, smaller purchases.
Makes sense. What else?
Second, they're optimizing their marketing efforts on third-party platforms, likely applying that same data-driven approach we saw work so well in Kazakhstan. Third, expanding payment options, specifically offering a wider selection of BNPL options from local Turkish banks to increase conversion at checkout.
Okay, delivery, marketing, payments. What's the fourth?
Fourth, rapidly redesigning the mobile user experience, the UX, trying to match the simplicity and the high conversion rates of the super app model they perfected back in Kazakhstan.
So that spending really validates the acceleration we're seeing in those everyday orders, and they're backing this operational investment up with actual capital, too.
They are fully committed. Hepsibada announced a share capital increase, expected to raise approximately $100 million. This cash injection confirms CASBI is willing to aggressively fuel this accelerating growth trajectory to try and establish ecosystem dominance in that massive Turkish market.
All right, let's take a step back then and try to summarize this whole deep dive for you listening. If we connect the dots across all 5 sections we've covered, what are the 2 defining themes that really jump out from this 3Q report?
I think there are 2 clear themes. First is domestic resilience. The core business back in Kazakhstan is incredibly robust. That underlying financial engine growing net income at 21%, remember, it's just being masked purely by temporary external macroeconomic pressures.
Right, the supply chain noise, the high central bank rate.
Exactly. They're masking a business that is actually executed pretty much perfectly underneath. That's theme 1. Theme 2 is radical forward-looking innovation.
Yeah, they're not sitting still.
Not at all. They aren't waiting for competition. They're actively building the next generation of payments with Kaspi Alcoin, the pay-by-palm. And they're deploying proprietary AI, Caspie, directly into the conversion funnel to boost sales right now.
And looking ahead, those headwinds we spent so much time unpacking the smartphone shortage, the high interest rates, they could actually flip and become tailwinds starting next year, couldn't they?
That's the crucial long-term outlook here. The smartphone supply disruption is temporary, which means by March 2026, they'll face highly favorable year-over-year comparisons. That should instantly boost reported growth figures.
Easier comps.
Exactly. Similarly, that high NBRK base rate, which currently squeezes margins. If the central bank begins a rate-cutting cycle in the next, say, 12 to 18 months, that squeeze could turn into a massive tailwind for their fintech profitability.
Right.
So the underlying growth story is entirely intact. And the momentum we're seeing in Turkey, validated by those accelerating purchase numbers, that's starting to gather critical mass.
That underlying structural health really makes the short-term noise seem much less concerning. Okay, for one final provocative thought for you to explore as you process all this data, let's just revisit the power of that Caspie we discussed.
Right. We saw that proprietary AI deliver up to an, was it 83% sales uplift on specific products, simply by automating optimization on the product page. This isn't just marketing fluff. This is automated transaction optimization.
So the question for you, the listener, is this. As these digital ecosystems like Caspie expand, they are embedding deep, specific intelligence directly into the sales transaction itself, potentially transforming the whole content creation process. What does this really mean for the future of traditional marketing, for SEO, for content creation agencies, when AI deployed right at that critical conversion point can deliver optimization results that seem far beyond what conventional human-led marketing campaigns can typically achieve?
That potential shift in power, maybe from the external marketer to the internal AI engine embedded in the platform, it's definitely something to ponder as these super apps mature globally.
A fascinating implication for pretty much every commerce business moving forward.
Indeed.
Thank you for joining us for this deep dive. We'll catch you next time.